Come on in, sit back and relax. You're listening to the WealthTech Today podcast, and I'm your host, Craig Iskowitz, the founder of Ezra Group Consulting. And this is our February news roundup, where we cover a curated selection of the most interesting news stories in wealth tech. But this month, there's one story that's so huge that I just don't have time to talk about anything else. And that story is Swiss bank UBS buying pioneering robo-advisor Wealthfront for $1.4 billion. I'm going to dive deep on this one, from reviewing some of Wealthfront's history and how we got here, providing details about the price and the valuation, as well as my opinion on whether this is a marriage made in heaven or possibly someplace farther south. But before we start, let me ask you, if you are an executive at an enterprise wealth management firm and you're having issues with one of your technology platforms, you need to call Ezra Group. Our consulting team has decades of experience with all aspects of wealth management technology, data, and operations. Whether you're looking to optimize an existing system, revamp it, integrate it, or replace it entirely, Ezra Group is the one call you should make. We help firms like yours make the right decisions regarding their technology for smooth front to back office operations. Go to EzraGroupLLC.com for more information. Let me take care of a few housekeeping items before we get started. A quick shout out to our sponsor for this episode, the Invest in Others Charitable Foundation. You can check them out at investinothers.org. Be sure to subscribe to the WealthTech Today podcast wherever you listen to podcasts so you don't miss future episodes. All right, now let's get the news started. UBS buys Wealthfront at a $1.4 billion deal. Of course, the story was in every media outlet that covers financial news, including the Wall Street Journal, Barron's, and all of the industry trade mags, Investment News, WealthManagement.com, ThinkAdvisor, FinancialPlanning.com, and so on. But one of the most informative pieces with the best reporting came from RIA Biz, written by Lisa Schindler. So go over there and read through it when you get a chance. We'll provide a link in our show notes. So what's been the history of Wealthfront? How did we get here? So Wealthfront was founded back in 2008 by Andy Ratcliffe, who also co-founded Benchmark Capital, one of the most successful venture capital firms. And they have been so successful, they've invested in companies like eBay, OpenTable, Snapchat, Twitter, and Uber. So Andy's a bit of a legend. And he actually started out this firm called Kaching. It wasn't called Wealthfront. And it was a crowdsourced investing platform that was going to shake up the mutual fund industry, where users could post their portfolios and others could invest in them. An idea which didn't last very long once they tried to monetize it. In 2010, the company made one of the many pivots, and they abandoned the crowdsourced idea and launched an online investment service. That's when the firm changed to Wealthfront. But it wasn't a robo-advisor yet. They actually relied on a group of 44 RIAs and asset managers to run their client portfolios. It wasn't until about the end of 2012 that they brought the portfolio management in-house and began levying their 25 basis points asset management fee. And the Wealthfront we know now was born. Ratcliffe was the original CEO until their COO, Adam Nash, succeeded him in 2014. And Nash was an alumni of both LinkedIn and eBay before joining the Kaching/Wealthfront. And under Nash's leadership, they had done something interesting. They started making bids to manage investments for the staff at all the tech corporations in Silicon Valley. Think companies like Facebook, Google, LinkedIn, Microsoft, Twitter. And it became a factor in their early success since they brought in a lot of assets from a relatively small number of clients, and also give them some cachet to say, hey, we've got all the Facebook money, we've got Google money. And also these were folks who had stock options that turned them into multimillionaires overnight. Wealthfront also rolled out a high net worth investment management service, tax loss harvesting, direct indexing, and one of the earliest providers to provide that. And their company motto was that we democratize access to sophisticated financial advice. And they were off and running. Ratcliffe returned to the CEO role in 2016. I was reading some articles around that time when Nash stepped down and Ratcliffe took over. And Darren Courtney, who at the time was a principal executive at CEB, said, and this is, I think, prophetic, where robo-advisors tend to fall short is where your true advice needs to go beyond simple allocation. And that's really true. The robo-advisors had to keep adding and keep expanding once they realized that the simple allocation of an ETF basket just wasn't enough to keep clients. They needed more. And as their clients started to get older, with these young tech people who were their core of their client base, started to get older, have families, and have more complex needs, they outgrew the simple robo-advising. So I've written about Wealthfront many times on my blog and been quoted in the press many times. Often, I have to admit, in a negative light. For example, I wrote one rather harsh article, which I entitled Dead Robo Walking, Why Wealthfront is Doomed, back in 2016. Now, their AUM back then was about 2.8 billion in AUM. Now, they've 10x'd it since then, so clearly they weren't doomed. But they really, the goal there was, what we were trying to say was they were never going to disrupt human advisors as they said they would. And as this Andy Ratcliffe was constantly talking about how human advisors are the past and that robo-advisors are the future. In fact, Wealthfront never even came close to catching the leaders, to becoming the leader in assets in robo-advice, digital advice, or online advice. Vanguard and Schwab, hoovered up 80% of the assets that were in that space, and Wealthfront and Betterment and all the rest were always chasing them. Now, I also wrote an article called "Why Acorns is the Only Robo-Advisor That Could Be Worth $1 Billion." That was also 2016. So inflation a bit since then, but everyone really wants that $1 billion valuation. It's so common that everyone just wants to be able to say that, hey, we got $1 billion. And that is sort of a badge of honor. Hey, we're successful. We made $1 billion valued company. And of course, $1 billion isn't what it used to be with inflation, but there's still firms looking to get $1 billion. Now, Wealthfront's been on the market since at least November of last year, when we saw some articles about them putting themselves on the block and trying to find some buyers, but really couldn't find anybody. There was rumors that they were they were shopping out to other wirehouses and major banks without any success. And even their custodian, RBC, was rumored to be looking at buying them, but turned them down. So I guess it took about 6 months for them to finally find somebody who was willing to pay at least what they could claim was $1 billion price tag. But was it really $1 billion? So that's another interesting aspect. There's some reporting, as I mentioned, from RIA Biz about the details behind the pricing. Turns out it's not a $1.4 billion deal. It's really a $700 million deal with a series of balloon payments if certain performance marks are hit. There's no guarantees. And this gives everybody an out. So the sellers, so Andy and his team, can say, look, we did it. We sold for 1.4 billion. We're heroes, congratulate us. But then the UBS can say, if things don't work out, well, look, we didn't really pay 1.4 billion. We never had to give them that other 700 million in balloon payments because they didn't meet all the performance marks that we told them to do, that they agreed to do. So we got a great deal on this asset. So let's everyone out of the deal. Now, this is not the first time this kind of deal has been done. If you look at last year and a very similar acquisition, Empower Retirement Company made $1 billion acquisition of another robo-advisor, Personal Capital, which also wasn't $1 billion deal. It was an $825 million deal with $175 million in incentives. Now, that's an interesting comparison because it's also a robo-advisor and close to the same amount of money, 825 versus 700. But if you look under the covers, it's a very different group of assets. And it almost makes you wonder if UBS overpaid for Wealthfront. So Empower paid 825 for Personal Capital. They only had 19 billion in assets versus Wealthfront's 28 billion in assets. But that's a set value for those assets. What Personal Capital has that Wealthfront does not is 2.5 million registered users on their platform of their aggregation and personal finance tools. That's a pretty big group of users that can be monetized for other things, sold other services, tracked. That data can be sold. So there's value to that asset that Wealthfront doesn't have. So now they do have 440,000 clients for their 28 billion, but that's still way less, whatever that's 1/6 of the number of users of Personal Capital. Now, Wealthfront has received $204 million in financing since then, and Personal Capital received 265, which was surprising. I really thought the numbers would be reversed, but when I looked into it over Crunchbase, you can check these out. Personal Capital, 265 million in funding, Wealthfront, 205 million. Still, not the great return that the VCs normally want. They're looking for 7 to 10x. So 3xing their money is basically a loss when it comes down to it. Look at how long the money's been sitting in there. I would think the VCs are really not happy about getting that type of return. Tim Welsh, president of Nexus Strategy in RIA Biz, said something similar. He said, they must be hiding in a corner, hoping no one notices they sold their disruptive platform to a 160-year-old bank and wirehouse. The irony is very rich here. These are the very same people they came to dethrone. So true. It's so true. So, it's even more ironic considering how many times Andy Ratcliffe has disparaged not only financial advisors, but banks recently. And that leads me to the next point, which is that Wealthfront became a bank. So they made another pivot in a long series of pivots, and which I don't think is bad. Firms have to pivot. You've got to change. The market's going to change. You can't play the same game because the rules change. So you need to change. So there's nothing wrong with changing. The problem is that you need to eventually be successful with one of these changes, or you're going to have to basically sell the house. So they pivoted from a financial advice firm, from, as they said, democratizing access to sophisticated financial advice, to a bank. In 2019, Andy was at the Invest conference and gave us a bunch of quotes. Now they had their pitch of self-driving money, that they're now a bank, they've got checking accounts, direct deposits, and then they've got algorithms that can help investors and their clients pay their bills more efficiently, move their money around more efficiently, put into a high yield savings account. All sounds good, interesting stuff. We're always open for innovative ideas, see if it'll work. But the disparaging remarks that Andy made about banks, just, it's got to come back to haunt him. Some of the things he said, and I tweeted about from the Invest conference in 2019. Banking is one of two industries with negative net promoter scores. Cable companies are the other. Banks run their businesses for their shareholders, not their customers. This is what holds them back. Then he said there's 50 million customers of retail banks that will eventually leave for a better solution over the next decade. I think he got that number from 30% of the 180 million people with bank accounts never go to a branch. And those are the ones that he's going to target to go to his new bank, which clearly didn't happen, but it's possible. So then they made another pivot even more recently with the success of Robinhood, that they started to offer crypto trading and more self-directed options for clients, giving the clients more options and more functionality. So again, lots of different options, lots of different things they were trying to do to make this successful, and they just could not get enough growth, could not bring in enough revenue to keep people happy and raise the valuation at all. And one of the reasons why was that they were pivoting so fast was that their growth was really slowing. It wasn't flatlining. They grew from back in 2019 when Andy was at the conference, they had 20 billion in AUM. And when they just sold, they had 28 billion, 27, 28. So what is that? It's like 30% growth over 2 years. Sounds good, but if you look at the RIA market, it's lagging. The average RIA grew their assets by 22%, I believe, over the past 2 years. So Wealthfront was really lagging the market in many ways, not just revenue, but in AUM. So they needed to sell. These different pivots weren't working. They weren't bringing enough new clients. But speaking of pivots, there was Andy Ratcliffe was on a podcast in May 2020 called the Lend Academy with Peter Renton, where they asked him about their pivots, and he said, "Well, I wouldn't call it a pivot," which was the banking pivot. And he said, "I would describe Wealthfront as a next generation banking service," which is interesting. It's just, you're really you're kind of grasping at straws here to try to find something that's going to attract people to your company. All right. So we talked about the price a bit. We talked about that. Then we talked about that. I should have mentioned this. So one of the things that we think with Wealthfront, and the reason I compare them to RIAs is they're really just an online RIA for much of their business life before they became a bank. And if you look at the RIA market, with 28 billion, it doesn't even put them in the top 10. Now it's good; they're like 11 or 12, so it's not bad, but they're not even the biggest RIA. So they've really got a long way to go to be successful, which is another reason why they had to sell. So why would UBS even buy Wealthfront? Well, you look at some of the press reports and some of the things that have been leaking out. They've been trying for years to offer digital advice solutions. UBS launched something called Smart Wealth in the UK in 2016, but shut it down and sold it to SigFig. That deal probably helped them learn more about SigFig, and which they eventually took an equity stake in later that year, and then agreed to use their software to open up a US robo-advisor. And then so that was their platform for that. So they were using SigFig for that platform, and that's been going well for a while, but clearly not quite as well as they thought. Or else, why buy Wealthfront? If your SigFig relationship is doing well, there's no reason to look at Wealthfront unless you're going to merge them together, which really makes no sense. UBS called their US digital advice program Advice Advantage. I was just searching for that name desperately. So they invested in SigFig, launched their robo-advisor, and recently in their October earnings release, UBS said it wanted to provide a seamless digital experience with remote human advice. So some sort of hybrid platform. And that was from Scott Smith, an analyst at Boston-based Cerulli Associates. Now, one thing I was reading that was interesting, that kind of leads me to think about this whole problem with Wealthfront and why they had to sell, was from a newsletter called FinTech Takes by Alex Johnson. You can look him up on Twitter, AlexH_Johnson, or fintechtakes.com. And his newsletter this week was talking about fintechs and the distribution versus manufacturing dilemma. Building a successful fintech company, or any company really, comes down to manufacturing and distribution. Can you build a compelling product that people want? And can you distribute that product reliably and efficiently, Alex writes. So it's manufacturing and distribution. They're the two challenges that every founder wrestles with. And the question that's interesting is, which challenge do you start with? So Andy Ratcliffe and Wealthfront started with manufacturing. They built everything from scratch. They built their tech platform. They built their company, raised VC money to try to buy distribution, drive distribution of their product. And it was moderately successful. But once the market reaches maturity, the key to winning isn't in the manufacturing or the building of the product. It's in the distribution. And that's in many different industries, and certainly in wealth management. Being bigger gives you so many advantages. You need to hit certain plateaus or to keep up with your competitors who can deliver cheaper, faster, better. So Wealthfront was really besieged on all sides by competitors, whether it's Vanguards and Schwab's launching their own robos and sucking up assets, or these self-directed firms like Robinhood and M1 Finance offering new stuff. There's even a company that just announced the other day called Compound. Came out of stealth mode with $37 million in funding, VC funding. They mix human advice with a technology approach. The next generation of wealth is holding a different suite of assets, one that traditional wealth management is often struggling to support. That's Compound. You can check them out. So there's always new ones coming out that are attracting their core client base of the 25 to 54-year-old millennials under 40. And it just became too much at some point, and that they need distribution. And where can they get distribution? A wirehouse. And UBS has got tens of thousands of clients, tens of thousands, 10 to 15,000 advisors. They've got the distribution, they've got product. They can make this work, if anyone can make it work. So that's really where they came to with a mature company, and they'll be morphed into something, either some form, and that's really where they had to go in order to take this to the next level and do the right thing both for their employees and their customers, which is what Andy Ratcliffe did. Now, question we were talking about. I talked about the pricing a bit. Okay, so that's done. Then 6 lingering questions following UBS's blockbuster purchase of Wealthfront. This is an article from my good friend Ryan Neal at financialplanning.com. Great article. Really interesting stuff here. I'm just going to read a couple out and talk about some of his questions, which I thought was a really good way to position this news. So what will happen to UBS's current robo-advisor program powered by SigFig, which we just talked about, the Advice Advantage? So there's 2 questions. What should happen and what is likely to happen? So if they ask me, you want to shut down the SigFig program. There's no reason to have 2 robo-advisor programs, 2 digital advice programs. Even if you do one hybrid and one not, you don't want to keep them. You want them on separate tech platforms. It makes no sense. So either you shut down Wealthfront and roll the assets over to SigFig, or vice versa. Although I would suspect, knowing what I know a little about SigFig, that maybe they would do the opposite and shut SigFig down and roll it over to Wealthfront. I don't know what's going to happen. I have no insider information. However, what I find is it's often political, that politics usually trumps common sense or what's best for the company in the long run, because people don't want to shut down their babies. So if the CEO or different heads of the company leaders have brought in a particular technology and then they buy something else, usually they're going to defend what they bought or what they built, and the newcomer gets hammered. But in this case, the former CEO Sergio Ermati is gone, but replaced by Ralph Hammers, and Rich Steinmeier, who was head of the Wealth Advice Center, is now divisional president at LPL. So both those leaders have moved on. So there's really no one standing in the way of shutting down the SigFig program and rolling that over into Wealthfront, which is what I would recommend, again, not knowing any more details about what's going on at the company. Did UBS buy Wealthfront for the technology, the user base, or a combination of both? So Michael Keatsis, I believe online, posted some of his back of the napkin calculations that based on a 25 basis points fee on 28 billion, Wealthfront's got about 70 million in revenue, which is UBS, means they're paying 21 times revenue for the FinTech. So, what does that tell you? Which is why what they're buying. It doesn't really tell you much about what they're buying, because of it's hard to evaluate the tech. The tech could be great and they don't have a lot of revenue, or the tech could be crap and they've got a lot of revenue. So I think it might be some combination, because again, UBS is a huge company. They don't need 28 billion in assets. That doesn't do anything for them. They pick that up on a regular basis. What's the joke that they find that in their couch cushions, $28 billion. So they're not going to pay that for that. I would imagine it's a combination of the people, the core technology team that they're getting en masse, and the technology that they believe they can use for their new Advice Advantage or their new hybrid technology program, or some form of other programs that they believe they can sell. They've got their Wealth Advice Center, they've got their Workplace Wealth Solutions. So there's lots of other things that they can sell this into. There's lots of other tools and lots of other options that UBS can use the Wealthfront tech for. So that's where I see them hopefully doing that, rather than throwing it away. They should be leveraging that into these other programs, which I think could be relatively lucrative for them.
Talk about one of our sponsors, the Invest in Others Foundation. The Invest in Others Foundation is a charitable foundation that helps charities which are supported by financial advisors. So if you know a financial advisor that supports a charity, either in the US or abroad, you can submit his or her name to the Invest in Others Foundation, to one of their programs, and they can be awarded money for their charity. The Invest in Others Foundation is running one of their programs right now called Grants for Good. The application deadline is next week, January 24th. So please submit your financial advisor, as you know, for this grant. I think they're awarding up to $100,000 in grants to a number of charities. So any person who works in the financial services ecosystem is eligible to apply on behalf of a nonprofit. Applications must be active, currently volunteering with the nonprofit, and you just fill out the form online, and you get a chance to get some money for these nonprofits. I've been honored to be a judge in some of these programs, and it's really tough. We have to look at 10 different charities and decide, and their advisors who help them, and decide which ones to get the money. It's really hard. So the more money that you donate to Invest in Others, the more of these grants we can give. It makes it easier for us to pick because we'll have more money to spread around. So please go to the Invest in Others Foundation, investinothers.org on the web. You can learn more about them. Thanks.
And now we come to the question that I think will decide whether this acquisition will succeed or fail. It is, how will Wealthfront's Silicon Valley culture fit in with a Swiss multinational bank? Wealthfront has long maintained a confrontational relationship with the traditional wealth management industry, and that is the understatement of the year. Between previous CEO Adam Nash and Andy Ratcliffe, and the current CEO, well, not the current CEO, David Fortunato, but Ratcliffe and Nash, they've certainly been antagonistic to traditional wealth management, seeing themselves as the disruptors. Not only antagonistic to wealth management, but antagonistic to banks as well. So it's definitely going to be an issue. And this is really where things will hinge. And in my opinion, it's going to be the straw that breaks the camel's back, because I've had a lot of people on this podcast, spoken to a lot of very successful people who've made really big deals. And one of the most important things in any merger or acquisition is culture. No matter how good the technology is or how many assets you're acquiring, if the culture of the teams don't mesh, if the culture of the businesses don't mesh, you're really going to have serious problems. And you have a high probability of failure, because that's really how things work. You just don't bring a Silicon Valley culture into a Swiss bank and say, okay, figure it out. Just everybody compromise and make this product work. When you hear things, like you hear things from the current CEO, David Fortunato, when he says these crazy statements, it was clear from the start that we shared the same values and culture. What are you talking about? Nobody believes that. I mean, at least tell the truth. At least say, hey, this is going to be a problem. We are coming from one area, they're somewhere else. We're the Hatfields, they're the McCoys, but we're going to make it work. But saying something like that doesn't help, in my opinion. UBS is a hugely profitable company, very good at what they do. And they're acquiring this firm. The odds that they do everything they can to make this work, but don't try to sugarcoat it or gaslight people to say we have the same values and culture. You certainly do not. It's nothing like this at all. So clearly everyone wants to make it work. Everyone wants us to go well, and it's going to seem pretty smooth at first. They're going to keep things independent, but at some point, whether it's a year or 2 years down the road, when the assets aren't growing quick enough, or there's too many departures of key people, and the new people who are taking over don't have the same knowledge, the same zeal, the same ideas, or the same leeway that Wealthfront had to pivot and change and increasingly change direction to eke every possible bit of assets out of their clients. That then things are going to start getting a little messy, and you might see UBS doing what Vanguard did when they launched their robo, which is just shift money over from one pocket to another to make it look like they're doing something. So they'll do that. They may turn this into some sort of Merrill Edge clone, where they can incentivize their advisors to ship small accounts over to the Wealthfront business, which will goose the assets and make that look good. Begin a marketing campaign for the existing client base, maybe even lower the price. 75 basis points is pretty high for what they're offering. They can start pushing their own products into the mix, which will also goose profitability quite a bit. So all these solutions will eventually happen, in my opinion. And eventually they'll retire the Wealth Firm brand and it'll become just another wirehouse product. Unfortunately, that's just the way things go. And we'll see how it goes. We always have high hopes for these mergers and this new stuff. But in the end, it boils down to dollars and cents, and someone's going to have to make a business decision as to. And that's the end of this episode. Thanks for listening. Glad you made it all the way through to the end. Hope you enjoyed what I had to say. Please go to our website, EzraGroupLLC.com, scroll to the bottom of the homepage and sign up for our newsletter. Every month, you will get an email chock full of wealth management, wealth tech goodness, news, analysis, updates, links, all kinds of interesting stuff for you to share and learn from. So thanks again for listening, and I'll talk to everyone again next time.